Hey there, Mad Money viewers. Welcome to another exciting episode where we delve into the intricacies of the financial world. Today, we're diving into the exciting world of options trading. This is a realm that can seem daunting at first, but with a bit of knowledge and practice, it can open up a whole new dimension to your trading strategy. Now, options can seem complicated, but trust me, once you grasp the basics, they can be a powerful tool in your investment arsenal. They offer unique opportunities that you won't find in traditional stock trading. Think of options as contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, called the strike price, on or before a specific date, known as the expiration date. This flexibility is what makes options so appealing to many traders. Now, why would you want to trade options? The reasons are numerous and compelling. Well, options offer a level of flexibility and control that traditional stock trading doesn't. You can use them to hedge against potential losses, speculate on future price movements, or even generate income through strategies like covered calls. You see, with options, you can tailor your trades to your specific market outlook, whether you're bullish, bearish, or somewhere in between. This means you can craft strategies that align perfectly with your market predictions and risk tolerance. Plus, options often provide leverage, meaning you can control a larger position with a smaller amount of capital. This leverage can amplify your returns, but it can also magnify your losses, so it's essential to use it wisely. But hold on, before you jump headfirst into the options market, it's crucial to understand both the potential rewards and the inherent risks. Options trading isn't a get-rich-quick scheme. It requires careful planning and a solid understanding of the market. Options trading isn't for the faint of heart, but if you're willing to do your homework and approach it strategically, it can be a lucrative addition to your investment strategy. It's all about balancing risk and reward and knowing when to make your move. So let's break it down. Starting with the advantages of options trading. We'll explore how you can use options to enhance your portfolio, manage risk, and potentially increase your returns. Stay tuned as we unravel the complexities and reveal the strategies that can make options trading work for you. One of the most appealing aspects of options trading is its flexibility. This flexibility allows traders to adapt to various market conditions and tailor their strategies to fit their specific financial goals and risk tolerance. Unlike traditional stock trading, where you're essentially betting on a stock's price going up or down, options trading offers a broader spectrum of opportunities. In traditional stock trading, your profit or loss is directly tied to the stock's price movement. However, with options, you can design strategies that benefit from different market scenarios, including sideways markets. Options allow you to profit from various market scenarios. Whether the market is bullish, bearish, or even stagnant, there are option strategies that can be employed to potentially generate profits. This versatility is what makes options trading so attractive to many investors. Let's say you're bullish on a particular stock. You can buy call options, which give you the right to buy the stock at a specific price. This strategy allows you to benefit from the stock's upward movement without having to invest a large amount of capital upfront. If the stock price rises above the strike price, your call options become valuable, and you can either exercise them to buy the shares at a discount or sell the options for a profit. This provides a flexible way to capitalize on bullish market conditions. On the flip side, if you're bearish on a stock, you can buy put options, which give you the right to sell the stock at a predetermined price. This strategy allows you to hedge against potential losses in your portfolio or to profit from a decline in the stock's price. If the stock price falls below the strike price, your put options gain value, and you can either exercise them to sell the shares at a premium or sell the options for a profit. This provides a way to benefit from bearish market conditions without having to short sell the stock. The beauty of options is that you can tailor your trades to your specific market view, giving you more control over your investment outcomes. You can combine different option strategies to create a customized approach that aligns with your financial objectives and risk tolerance. Now, let's talk about leverage. Leverage is a powerful tool in options trading that can significantly enhance your returns. Options contracts typically control 100 shares of the underlying stock, but you only need to pay a premium, which is a fraction of the total value of the shares. This means you can control a large position with a relatively small investment. This leverage can amplify your returns significantly. For instance, a small percentage change in the stock price can result in a substantial percentage change in the value of the options contract. For example, if you buy a call option for 100 rupees with a strike price of 1000 rupees and the stock price rises to 1100 rupees, your option could be worth 200 rupees, doubling your investment. This demonstrates the potential for high returns with a relatively small initial outlay. However, it's essential to remember that leverage works both ways. It can magnify your losses just as easily as your gains. If the stock price moves against your position, the losses can be significant, and you could lose the entire premium paid for the options contract. Therefore, it's crucial to use leverage wisely and to have a clear risk management strategy in place. Options trading isn't just about speculating on future price movements. It can also be a powerful tool for income generation and risk management. Let's dive into how options can help you achieve these goals. One popular strategy for income generation is selling covered call options. This strategy involves selling call options on a stock you already own. By selling these options, you collect a premium which provides immediate income. If the stock price stays below the strike price, the options expire worthless and you keep the premium as profit. However, if the stock price rises above the strike price, you may be obligated to sell your shares at the strike price, limiting your potential upside. Another compelling application of options is risk management. Options can act as a form of insurance for your portfolio, hedging against potential losses in your stock holdings. For example, if you own a significant position in a particular stock and are concerned about a potential market downturn, you can buy put options as a protective measure. Suppose the stock price declines. The put options will increase in value, offsetting some or all of your losses in the underlying stock. Let's explore these strategies in more detail. Selling covered call options is a conservative strategy that can generate additional income from stocks you already own. This approach is particularly useful in a stagnant or slowly rising market, where the stock price is not expected to surge dramatically. The premium collected from selling the call options can be used to enhance your overall returns or reinvested into other opportunities. On the other hand, risk management through options is crucial for protecting your investments. Buying put options can be likened to purchasing insurance for your portfolio. Just as you would insure your home or car, put options provide a safety net against significant declines in stock prices. This strategy is especially valuable during times of market volatility or economic uncertainty. By incorporating these option strategies into your investment plan, you can achieve a balance between generating income and managing risk. It's important to understand the mechanics and potential outcomes of each strategy to make informed decisions. Consulting with a financial advisor or doing thorough research can help you tailor these strategies to your specific financial goals and risk tolerance. In conclusion, options trading offers versatile tools that can enhance your investment portfolio. Whether you're looking to generate additional income or protect your assets, understanding and utilizing options can provide significant benefits. As with any investment strategy, it's essential to stay informed and consider your individual circumstances before diving in. With the right approach, options can be a valuable addition to your financial toolkit, helping you navigate the complexities of the market with greater confidence. Section 4. TCS. A real-world example of options trading. Let's bring these concepts to life with a real-world example from the Indian stock market, focusing on Tata Consultancy Services, or TCS, a leading IT services company. Imagine you're bullish on TCS's future prospects based on its strong earnings growth and expanding market share. From a technical analysis perspective, you notice that TCS's stock price has recently broken above a key resistance level, signaling a potential upward trend. Furthermore, the Relative Strength Index, or RSI, a momentum indicator, suggests that TCS is not overbought. Fundamentally, TCS boasts a solid balance sheet, healthy cash flows, and a consistent track record of dividend payments, further supporting your bullish outlook. Based on your analysis, you decide to buy call options on TCS with a strike price slightly above the current market price, anticipating a further rise in the stock's value. Section 5. The downside, complexity, and risks. Now, before you get too excited about the potential rewards of options trading, let's take a hard look at the inherent risks and complexities. Options trading is not for the casual investor. It requires a solid understanding of options strategies, market dynamics, and risk management principles. One of the most significant drawbacks of options trading is its complexity. Options contracts come with various terms and conditions, and understanding these intricacies is crucial for making informed trading decisions. Factors like strike price, expiration date, implied volatility, and option. Greeks can significantly influence an option's value, and misinterpreting these elements can lead to substantial losses. Moreover, options trading involves a higher level of risk compared to traditional stock trading. Due to the leverage inherent in options, even small movements in the underlying stock price can result in magnified gains or losses. Additionally, options contracts have a limited lifespan, and if the anticipated price movement doesn't occur within the specified time frame, your options could expire worthless, leading to a complete loss of your investment.